China is, without a doubt, progressing by leaps and bounds. Achieving the status of the world's second-largest economy, right behind the United States, is not an easy task. But since China has done it, it is evident that they are doing things right. Now the question is it really the case? Are all the Chinese policies perfect, or do they have loopholes too? Behind the walls of the prosperous nation, we see the Chinese as there is a major problem. A problem involving tax. A problem that costs the country billions of dollars and is preventing it from reaching its true potential. To better understand, let's dive deep into the problem in this video. The Chinese tax system is much too regressive for its own good, and its social insurance system is not nearly as evolved as it should be. As a consequence, China has to increase the tax revenue it collects from people in higher income brackets and significantly boost the amount of money it allocates to social spending. This includes the public health sector too. It goes without saying that China is an expert in the practice of state capitalism. The Communist Party either directly or indirectly manages a large number of China's most successful businesses. Large privately held businesses can generally only maintain their level of success if they continue to enjoy the favor of the party state and, as a result, are subject to the pressures to conform their activities to the objectives of the state. China is full of state-backed investment funds intended to promote strategic industries, and the state still directs a significant amount of purchasing, enabling it to favor home enterprises and domestic production. However, in contrast to the European countries that utilize hefty taxation to equalize market outcomes, China effectively taxes the lower half of the population at a higher rate than the higher end of the population. Only those with the highest possible income are subject to paying income tax, and even then, it does not bring in a significant amount of money. As a direct consequence of this, the majority of China's tax revenue comes from the value-added tax as well as extremely progressive social contributions. Because of China's limited tax resources, the amount of money the country is ready to spend on social insurance is also restricted. Thus, China's method of taxes and spending does very little to modify the unbalanced and highly unequal society. The amount of tax income China collects is decreasing. The rise in economic uncertainty has had an effect on enterprises, which has resulted in a decline in company operations. On the other hand, the implementation of a number of fiscal measures designed to support businesses will have an effect on tax collection. Already during the period of January through June of this year, tax income, according to China.org, amounted to roughly 8.56 trillion won, which is 14.8% lower than the equivalent time in the previous year's revenue. In June, the percentage of China's GDP that was contributed by taxes was 11.3%. Even if it was considerably higher than 4.3% in May, the overall economic uncertainty would cause China's policymakers to have concerns. But the ratio of the total tax revenue to a country's GDP, which is also a crucial indicator of economic health, has historically been higher for China. However, in the year 2020, which was the year in which the COVID-19 pandemic began, it naturally slowed down to approximately 8%. Another issue that China is currently dealing with is a slowdown in the sale of land, which accounts for around 1/3 of the revenue collected by local governments. In the month of June, it was down by 65% compared to the same month last year. According to the official Monetary and Financial Institutions Forum, taxes levied on the purchase and sale of property account for 1/4 of China's total local tax collection. After recording a record growth of 4.8% from the first quarter of this year to the third quarter, the country's gross domestic product increased at a meager rate of 0.4% as a result of the tight lockdowns generated by COVID-19. The unexpected dip in China's manufacturing output, assessed in terms of Purchasing Managers' Index (PMI), to 49 in July and 50.2 in June, was shown by data that was issued by the National Bureau of Statistics (NBS). This only served to exacerbate the existing issue. The forecast of the analysts called for the figure to rise to 50.4. Any score that is lower than 50 suggests a contraction, whereas any value that is higher than 50 shows growth. Another problem China is facing is tax evasion. Tax evasion is widespread in China. The income tax system is currently undergoing a redesign that has been planned for a while. The mission may have become more urgent as a result of the tax evasion incident this summer involving Fan Bingbing, China's most well-known actress, who was shown by a whistleblower to have avoided paying 300 million won in taxes. The final fine for Miss Fan was 884 million won. In large cities, salaried professionals have long complained that they pay an excessive amount of taxes. This is due to the fact that businesses are legally compelled to deduct taxes from employee salaries. The wealthy, whose income typically does not come in the form of a paycheck, and those who work in the informal economy find it quite simple to avoid paying taxes. Even those who get a salary might avoid paying taxes by setting up to receive the majority of their pay in cash under the table, keeping their declared earnings below the threshold at which income tax is first assessed. Because it enables them to avoid paying social insurance contributions, which can amount to as much as 40% of an employee's salary, employers agree to this swindle. But over the last 22 years, China has had a budget deficit in 21 of those years. About 50% of the GDP is currently devoted to public debt. Even if none of these numbers should cause worry, especially in comparison to the rich world, the economy's slowing development will eventually make it more difficult to manage the government's debts. Therefore, it makes sense that officials would like to increase revenue. Indirect taxes like consumption taxes are often preferred by authoritarian governments, in part because they are less likely to incite hostility than income taxes. If the government is successful in growing the number of taxpayers, pressure may build on it to provide citizens with greater information about how their money is spent, and perhaps even a voice in how it is used. And the last problem is that the Chinese income tax system is disjointed. There are different tax rates for various types of income, and it does not become significantly effective until a certain point in the distribution of incomes. In addition, the current social insurance system in China is funded by social contributions, and there is a high minimum contribution requirement. While there is a relatively high exemption threshold for personal income tax, the flat nominal amount of social contribution at the bottom places the significant burden of an effective tax rate greater than 40% on lower-income families' shoulders. According to the International Monetary Fund, the bottom 50% are subject to a tax rate that is higher than all other percentages save the top 5%. Additionally, China does not tax the assessed value of property. As a result, the country has very low rates of taxation on accumulated wealth. Thus, the fiscal policy has only had a limited role in moderating income disparity in China. This brings us to the end of this video. If you liked the video, please consider subscribing and sharing so we can keep bringing more content like this. Also, let us know your thoughts in the comments below. See you next time!